Hello, it's Finance Talk. Today we will talk about free cash flow, how to calculate it, how the company distributes these sums, and what is the difference between net income and free cash flow. Stay tuned. Free cash flow is the indicator of how much money the company has on hand at the end of the year after all expenses. It's one of the most important indicators which shows whether the company can pay out its obligations with the cash it already has. To calculate free cash flow, we go on the cash flow statement of the company, take the operating net cash flow, and subtract capital expenditures from that. The company can distribute free cash flow in different ways: dividends, reinvest, buybacks, interest, and debt repayment. If the company has high debt, the CEO of the company can pay out some portion or all of it. The interest payment of the debt might decrease, which will improve the price of the stock. For example, the company has 2 billion in debt, 1 billion in net earnings, and 100 million in interest payment every year. 5%. The company decides to pay out a portion of its debt, 500 million. Next year, the total debt will be 1.5 billion and the interest will be 75 million. This will increase the profit of the company, which will affect the stock price. The company can also reinvest a part of the profit back into the business. Usually, it is made if the company has a high growth rate and high return on the investment capital. In this case, the reinvestment will be beneficial both for the company and for shareholders. The other way is to buy back shares of the company if the management thinks that company stock is undervalued. In this case, shareholders will win because their share in the company ownership will increase without doing anything. And on the other side, if the company decides to issue more stocks, the percent of the company which you own will decrease. For example, the company has 1 million shares outstanding on the stock exchange and you personally bought 10,000, which equals 1% of the company. The company reported that it has 1 million for dividend payments. In this case, your dividends will be 10,000, $1 a share. Then the management decides to buy back 500,000 shares. You still have 10,000 stocks, but now it's worth 2%. 10,000 divided by 500,000. If the company has same 1 million for dividends, they are now divided between 500,000 stocks, and now you have dividends of $2 per share, $20,000. The last way to distribute free cash flow is to pay dividends for the company's shareholders. Usually the management uses this solution only when the company has no other way to distribute the money. For example, by acquiring other companies or reinvest in its own business. Sometimes there are also situations when free cash flow is negative. Why does this happen? It happens when company inflows exceed its outflows, meaning that the company spent more money on operating activity or capex, capital expenditures, which is sometimes not healthy for the business. Some people also ask, what is the difference between the net income in the income statement and free cash flow in the cash flow statement? To answer these questions, it should be said more about these two statements. An income statement is a document where the company lists all its profits and expenses for the particular period. The cash flow statement shows all cash flows which are calculated based on inflows and outflows of money from the company's bank account. Net income is not pure number which you can analyze as an investor because the company can decrease it by adding more expenses to particular categories. On the other hand, a cash flow statement is a more objective document. Also, the company can state that, for example, in 2021 it earned 100 million, but according to cash flow statement, only 90 million came on company's account and the rest will come next year. It is still the company's profit, but it is not on the bank account yet, and the company cannot pay out anything with this money. Now let's speak about great examples of free cash flow. One of the greatest examples is Berkshire Hathaway. What Warren Buffett did is the art, because he created a company which buys public and private companies and receives dividends from them, which is a complete free cash flow for the company. Then the management reinvests all this money he doesn't pay dividends into other businesses, increasing the company's revenue. And the results speak by themselves. The price of the share rose from 7,200 in 1990 to more than 472,000 in 2022, more than 20% compound annual interest rate for 22 years. The other example is Coca-Cola. For the last 5 years, the company had a consistent growth of free cash flow for 20%. Hope this video was useful for you. If you enjoyed the video, please leave a like and subscribe for more great videos. Bye!